In February 2022, something happened that had never happened before in modern financial history. Western governments froze $300 billion in Russian central bank reserves. Not sanctioned, not threatened, frozen, overnight. Assets that sovereign nations had spent decades accumulating as insurance against exactly this kind of crisis. Gone. Inaccessible at the click of a political decision. Every central bank on earth was watching, and what they saw terrified them. Not because they supported Russia, but because the reserves that were frozen were held in dollars, euros, and pounds, the same currencies every other central bank on the planet was holding. The message was unmistakable. If you are on the wrong side of a geopolitical conflict with the West, your reserves are not really yours. Within months, central banks worldwide accelerated gold purchases to levels not seen since the 1960s. China and Brazil announced they would settle bilateral trade in their own currencies. Saudi Arabia opened conversations about accepting yuan for oil. The BRICS bloc put a common currency on the agenda. Commentators declared the beginning of the end of dollar dominance. Here is the problem with that story. None of it worked. The yuan is not freely convertible. CIPS, China's alternative to the Western payment network, handles a fraction of global transaction volumes. Gold pays no interest and cannot settle a trade invoice. The BRICS currency went nowhere, and the dollar's share of global reserves, while it has declined from above 70% 2 decades ago, still sits at roughly 58% today. No other currency is above 20%. Countries are trying to escape the dollar. They are failing. And the reason they are failing is not what most people think. This episode is about why the dollar cannot be killed, why that does not mean it is invincible, and what the actual structure of monetary power tells us about the next 20 years of great power competition. To understand why the dollar is so hard to displace, you have to understand what it actually does. Not in the abstract, but mechanically. The dollar is not just a currency, it is infrastructure. When a company in Germany buys copper from a Chilean mine, the invoice is almost certainly in dollars, not because Germany or Chile particularly wants that, but because the global commodity market runs on dollar pricing, and deviating from it means finding a counterparty willing to accept a less liquid alternative. When a bank in Singapore transfers funds to a bank in Nigeria, that transaction almost certainly clears through a correspondent bank with access to American payment systems. When a central bank in Southeast Asia needs to intervene in its currency market during a crisis, it reaches for dollar reserves, because dollars are the one asset every other market participant will accept without hesitation. This is what economists mean when they talk about network effects. The dollar is valuable because everyone uses it. Everyone uses it because it is valuable. And the cost of breaking that loop is not paid by one actor. It is paid simultaneously by every actor trying to coordinate around something else. There is a second layer. The U.S. Treasury market is the deepest, most liquid government bond market in the world. Daily trading volumes exceed $500 billion. A central bank can park $200 billion in treasuries with confidence that it can sell quickly if a crisis demands it. No other market offers that. Not European sovereign bonds, which are fragmented across 19 national issuers with different credit qualities. Not Chinese government bonds, which are large but constrained by capital controls that limit what foreign holders can actually do with their positions. Not gold, which pays nothing and requires a buyer at the moment you need cash. Safe assets are not just about yield. They are about the ability to get out when everything else is falling apart. And in every crisis of the past 30 years, the Asian financial crisis, the 2008 global financial collapse, the COVID shock of March 2020, capital did not flee the dollar. Capital fled to the dollar, even when the crisis originated in the United States itself. That is not a coincidence. It is a structural feature of a system built over 80 years. The deeper question is how the dollar acquired this position in the first place, because it was not inevitable and it was not accidental. The modern dollar system was born at Bretton Woods in 1944 when American negotiators, holding most of the world's gold and producing roughly 40% of global output, designed an international monetary order around the dollar. Other currencies were fixed to the dollar. The dollar was fixed to gold at $35 per ounce. The U.S. became the anchor of the system by design. What nobody fully anticipated was what would happen when that anchor was removed. In 1971, with American deficits mounting from the Vietnam War and Great Society spending, President Nixon suspended dollar convertibility to gold. The Bretton Woods system collapsed. By conventional logic, this should have destroyed dollar dominance. Instead, something stranger happened. The dollar became more dominant, not less. The reason was oil. In the years following the 1973 OPEC crisis, a quiet arrangement emerged in which Gulf oil producers, led by Saudi Arabia, agreed to price and sell oil exclusively in dollars. Petrodollars flooded back into U.S. Treasury markets. Every country that needed to import oil suddenly needed dollars to do it. The commodity most essential to industrial civilization became a structural source of dollar demand that had nothing to do with American economic policy. That arrangement has never formally ended. This is what monetary power actually looks like. It is not a policy you implement. It is a structural position you occupy, and once occupied, it generates its own self-reinforcing logic. The more countries use dollars to buy oil, the more they hold dollar reserves. The more dollar reserves exist, the deeper treasury markets become. The deeper treasury markets become, the more attractive the dollar is as a reserve asset. The loop closes. But here is the part that matters for today. Every time the United States weaponizes that structural position, through sanctions, asset freezes, or exclusion from payment systems, it makes the loop slightly more vulnerable. Not because the dollar weakens in any immediate sense, but because it makes the political costs of dollar dependence visible in ways that previously went unnoticed. Russia did not seriously pursue de-dollarization before 2014. Iran built workarounds precisely because it had no choice. China began its Yuan internationalization program specifically because it understood, watching both cases, that dollar dependence was a strategic liability it could not afford to carry into a confrontation over Taiwan. The weaponization paradox is real. Using financial power is most effective in the short term and most corrosive to long-term dominance. Every sanctions regime that proves the dollar can be deployed as a weapon also proves to every other state that depending on the dollar carries risk. Here is where the conventional de-dollarization narrative breaks down entirely. The countries most motivated to escape the dollar are discovering that the exit is not a door. It is a wall with a very small crack in it. Take China, the most serious and best-resourced de-dollarization actor on the planet. China is the world's largest trading nation. It has the second largest economy. It has spent over a decade building CIPS, establishing currency swap lines with dozens of central banks, and promoting yuan usage in Belt and Road lending. And the result? The yuan accounts for roughly 3% of global reserve holdings. SWIFT still handles the overwhelming majority of international payment messaging. The dollar still dominates. Why? Because full yuan internationalization requires full yuan convertibility, and full convertibility requires opening China's capital account. And opening the capital account means accepting that Chinese citizens and corporations can freely move money out of China, which means the party loses control over credit allocation, capital flows, and ultimately the domestic financial system that underpins its political authority. This is the impossible trinity in practice. You cannot have monetary policy independence, free capital movement, and a managed exchange rate simultaneously. China has chosen the first and third, and that choice makes the yuan unsuitable as a genuine reserve currency for the foreseeable future. Not because China lacks ambition, because the political cost of genuine internationalization is a degree of financial openness that the Chinese Communist Party cannot accept without transforming the nature of its own governance. Russia learned a different and harder lesson. After 2022, Russian trade shifted rapidly toward yuan settlement. But this did not produce autonomy. It produced a new dependency. Russia can now use yuan for transactions with China. It cannot easily convert those yuan into other currencies because Chinese capital controls limit convertibility. It cannot use them to buy goods from countries outside the China relationship. Russia traded dollar dependence for yuan dependence, and the new arrangement is governed by a partner whose interests will not always align with Moscow's. The pattern holds across every alternative that states have tried. The euro lacks a unified safe asset because Europe lacks fiscal union. Gold cannot settle invoices or provide crisis liquidity. Digital currencies, whether central bank or decentralized, reproduce the same trust and convertibility problems in a new technical format. And regional currency arrangements, from the Gulf Cooperation Council to BRICS, have spent decades producing communiques and missing their implementation deadlines. The dollar persists not because it is perfect. It persists because replacing a reserve currency requires solving a coordination problem of extraordinary difficulty. Every actor needs to switch simultaneously, or the network effects of the incumbent currency continue to make defection individually irrational even when it is collectively desired. In the entire history of the modern monetary system, this problem has only been solved once, when the dollar replaced sterling, and that transition took 2 world wars, a Great Depression, and 30 years. That is not a timeline that moves at the pace of a geopolitical news cycle. So where does this leave us? The honest answer is, in a long, slow, messy transition towards something that does not yet have a name. Dollar reserve shares have declined from above 70% in the early 2000s to roughly 58% today. That is a real shift. Over the next decade, further gradual erosion toward 50 or even 45% is plausible without any single rupture. The euro will likely hold its position as a genuine second-tier reserve currency. The yuan will grow, but slowly, and subject to the capital account constraints that Chinese domestic politics impose. Gold will continue to accumulate in central bank vaults, not as a monetary instrument, but as a geopolitical hedge against the weaponization of the very system it was once the foundation of. This is not dollar collapse, it is dollar dilution. And dilution is harder to defend against than collapse, because it happens at a speed too slow to generate the political will required to address it, and too fast to be ignored by anyone tracking the structural position of American financial power over a decade rather than a quarter. The strategic implication is this: the dollar's greatest vulnerability is not a Chinese alternative currency or a BRICS payment system. It is the cumulative effect of American decisions to use financial infrastructure as a coercive instrument in contexts where the long-term cost to systemic credibility exceeds the short-term policy gain. Every sanctions regime that proves the system can be weaponized sends another cohort of central bank reserve managers looking for the exit. And while none of them will find a clean exit anytime soon, their persistent search is slowly building the institutional knowledge, payment infrastructure, and political relationships that a future transition would require. The dollar cannot be killed, but it can be weakened from within. And the actors doing the most damage to its long-term position are not in Beijing or Moscow. They are in Washington, making decisions about when and how to use a tool whose power depends on the willingness of others to remain inside the system it governs. That is the de-dollarization dilemma. And it does not resolve in a headline. It resolves over decades, quietly, in the reserve composition decisions of central banks that have stopped fully trusting the infrastructure they cannot yet afford to leave. The structure behind everything covered in this episode, the network effects, the Triffin dilemma, the weaponization paradox, the coordination problem that makes reserve currency transitions so rare, I work through all of it in systematic detail in the de-dollarization dilemma. It is part of the Anatomy of Power series, and it is the most comprehensive treatment I have written of how monetary power actually works and where it is going. The link is in the description if this episode raised more questions than it answered. If you are coming to this channel from the Critical Minerals series, there is a direct connection worth noting. The dollar denomination of global commodity markets, including lithium, cobalt, and rare earths, is itself part of the structural dollar demand this episode analyzed. The two stories are linked. I cover that intersection in the Elements of Power, also linked below. If this kind of analysis is useful to you, subscribe. The channel covers the real architecture of international power, not the news cycle. New episodes every week.